Hello guys, welcome back to the channel. In this video I wanted to just go over some concepts that I've been using lately to frame up my trades. It's some brand new stuff, but also uses classic magic logic that I've always been using in the past. So if you're familiar with some of my concepts, this is going to come easily to you. Now this video is just going to be going over the basics of these concepts that I'm using now. As some of you may know, I took a little break earlier this year from both trading and mentoring. I'm still on a break from mentoring because personally my strategy and my psychology were not where I wanted them to be. And in order to be a mentor in trading, I feel like you have to be, happy with both your psychology and the way your strategy is performing. Because I wasn't happy with either of those things, and the fact that I want to be an honest, transparent trader, I decided to make the decision to stop all subscriptions to Magic FX for the moment and really work on myself and my strategy. And what you'll be seeing coming out over the next few weeks are the results of that, which I've been really pleased with. So without further ado, this is Robin, by the way, part of the other reason why I took a little break and why I look so tired at the moment. Let's get into the video. Like I said in the intro, the concept I'm going to be going through today is nothing really too new for those who have been following this channel for a while. I was just exploring it in a new way. And what's allowed me to do that is moving away from that mentorship role and allowing myself to reset and look at trading from almost a beginner's perspective. And it's really given me that sense of freedom to just go into a blank slate of the market, knowing what I already know, knowing the theories that I've created and learned throughout my years as a trader, and really start with a blank slate. It's been a breath of fresh air, to be honest. And the results are what you guys are going to be seeing over the next few weeks. And so the concept I'm going into today is open for business and closed for business ranges. And this is something I've talked about in videos before. Those of you that are familiar with the 1 minute magic method as well, that whole strategy that is based on the 1 minute is based on open for business and closed for business ranges. And it's always been, I've always looked at price as being something that has areas that are most likely to get strong reactions. So what is this concept? For those of you that don't know, if I have a valid low that's formed, then a valid high is formed, what is my expectation next? Well, it's that we get a pullback, and then if we hit the discount of this range, so at least the 50 between the high and the low, and then push back up, if we've hit the discount and we've tapped what I would call and define a valid zone, and if you want to know what that is, look at the second video I ever uploaded to this channel. Nothing has changed there from what I consider a valid zone. Basically, it's anything but imbalance is a valid zone for me. Now, if we tap that, move on. This is a closed for business range. So this is how we define the range. Premium and discount. This is closed for business. Let me make that a little bit more visible. Now, if we either don't make the discount or we fail to tap a valid zone in the discount, this area here below that low is open for business. The valid zones in this discount that price did not tap are open for business, and in the future, at some point, don't know when, if price comes back to this area, we can expect that there will be some sort of reaction to a zone in here. Okay, a strong reaction worthy of a trade. Now, what is good about this is that if we use multi-time frame analysis, and what I do, I use mainly the 4 hour and the 15 minute to frame up my trades. A 4 hour reaction, even if it doesn't do loads of stuff on the 4 hour, even if it's just like a little move like that, that's going to be a decent amount on the 15 minute, and my entry time frame is still the 1 minute. And so a 4-hour move like this on the 1 minute is a decent buy, okay? And that's all we're looking for. We're looking for reactions from these zones. And so what I also find is true is that price moves from one open for business to another. So from opposing open for business ranges. So for example, if this was the situation here, we had a selling range from here to here, failed to mitigate, and then push down into our zone here, I would expect price to at least take this. Now, what I would call the points of price that fail to tap the zone or the discount, that's what I define as my inducement. So this is inducement, and this is inducement. And these are great areas to target. You don't have to use this concept, but for me, I find a lot of the time, if price is going to work out from one of these areas, it's going to at least hit the next area or the opposing inducement above it. So for me, they're great places to target. Going on to the real charts, how am I framing up this? How am I looking at ranges? Well, what I'm no longer doing is caring about swing structure. And this has been true for a while, but whereas previously I'd be looking at previously broken lows and highs, and it would actually sometimes take ages to figure out what was the true swing structure, because you could have big moves like this where the actual swing low is all the way down here and it's only just broken it here. Whereas now I use the concept of cemented candles, cemented highs and lows, and just mark ranges between cemented highs and lows. If you want to know what a cemented high or low is, go to the first video I ever uploaded on this channel. And there's plenty of other videos that I've talked about cemented candles. Basically a candle that engulfs the candle to its left. So this is a cemented low because of this candle here, because this candle engulfed this candle after creating this low point here. And then this is a cemented high because this is the candle that's cemented, because it closed below the candle to its left here. It doesn't matter how many candles after that highest point is created, price engulfs. It just matters that it does. And so I look at these areas as my ranges, how I define my ranges. So from here to here, you can see this tapped a valid zone and pushed up. So this is a closed for business range here. If we just follow this up, this is an open for business range right here. We could just keep following this. This for me is an open for business range, doesn't tap a valid zone to the left. You can see after price does come into an area later on, such as this valid zone, it has reactions from it on the 4 hour, and yes, it doesn't play out, it doesn't go all the way to the previous inducement. It won't always have that full on reaction, but remember, this is the 4 hour. On the 15 minute, that's a good few hours of bullish price action. Okay, yeah, and so on and so forth. If we just keep marking these areas, you can see this is quite clearly closed for business for pushing up. And then we have this here again, an open for business area of price right here, and you can see price taps in, has this strong reaction from the zones down here. We have this here to here, and this was closed for business, mitigated this wick here and pushed up, and literally just following price like this. Okay, so that is the concept. And then going the other way in the selling ranges, you can see from here we have here to here, we push down, cement the low here, fail to tap the premium, come in, tap that premium and start pushing down, have that strong reaction. Again, failed to tap the premium, pushes down, comes back later on, taps a valid zone in the premium and smashes down. And this is the way price moves over and over again. And you can see, again, this is an open for business premium right here. There's the valid 4-hour zone, but you can see it is just, it's taken this inducement and shot down, possibly tapped something on the 15-minute to the left here. And yeah, this is what price does over and over and over again. What do we do with that? Well, what I will do and what I find is that the 15-minute frames up most of my trades day to day. So I've got the 15M, you know, so just as I record this, there is this open for business leg of price right here. See, it clearly never came back to the premium, to the discount, I mean. And then price is actually NFP that brought price all the way down here. It tapped into something here, and then it started to push up. And you can see on the 15-minute, where would the next target be? Well, where is the selling inducement? So we have this leg of price here, and you can see that price never mitigated that premium. Where's the inducement? It's the highest point that failed to mitigate the discount or the premium. And so the target would be, if you got in this trade, something like that, targeting that high right there. Now the entries themselves are something I'm not going to go into in this video, but it requires a set of confirmations, both on the 15-minute and the 1 minute, and yeah, that's pretty much it. The main thing to get out of this video is those open for business areas, and they're the ones that you really want to be looking at taking your trades from. Now, this is something that you may take to a completely different strategy. If you're looking at a typical supply and demand or SMC kind of trading strategy, this could give you some just clarity on refining down your zones to areas that are open or closed for business, and kind of eliminating certain areas and all that kind of thing. It's just a very nice way of defining liquidity, if you like, with this inducement. So liquidity for me is always the areas that fail to mitigate a discount and push up. So this would have been clear liquidity there, and obviously that got taken, and we've tapped in here and it's pushing up. And then this is the liquidity that failed to tap this. There was an example of a trade on AU yesterday, quite a nice trade, I believe. We had to look to the left right here. This is an example of how we use the 4-hour as well, how you can use that. So right here we had a push down, a failure to mitigate. This is the inducement. And then later on, price came into this area here, and then we go fractal and look at that on the 15-minute, and we can see that within that we had this 15-minute open for business, this inducement that was taken right there, and where did it hit? Tapped in. You can see it just tapped into this premium area right here. And if we make that 15-minute, and we go back to the 4-hour, make that visible, you can see that that is a nice 50 minutes sitting within that 4-hour. Price taps in and gives a lovely sell. This is towards the end of the New York session. Really easy entry up here. And you can see price just absolutely melted down. And because it was a 4-hour zone, you can have more of a 4-hour target on that. For the 4-hour targets, I tend not to go for that, next inducement. So what that would be probably that level of price there. I don't think it quite taps that discount. No, so that would be the 4-hour inducement for buys. But for me, on the 4-hour, I'm happy just to take it down to areas in the 4-hour discount. So inducements on the 15-minute. So in terms of looking at a trade here, you can see that there was an open for business range right here on the 15-minute that also fit in with the 4-hour. So that inducement right there would be perfect to target. And you can see price does eventually get there. So getting in right here. And again, it's optional to use that 15-minute, use the 4-hour is optional, but it gives you a bit more confidence to hold trades for longer, and it's an easy way to look at the big picture rather than just the small picture. But yeah, that's pretty much a summary of what I've been doing. There will be more content coming soon. You can see this is pushing up real nice to that area up there. And again, this was a really simple trade. Tapped in, pushed up, gave that 1-minute confirmation, and it's heading to target quite nicely. So, lovely.